Good evening, everybody. A very happy new year to all of you. I'm Rasmeet Kohli, Senior Assistant General Manager, and I'm working in the Investor Education Department of NISM. As you all may be aware, NISM is the capacity building initiative of SEBI, and we at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we primarily work in five broad areas, which are the long term and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and the academia, and various investor education initiatives. And one of the important investor education initiatives that we conduct on a weekly basis is the investor education webinar, which which you are attending today. So we have introduced a series on foundations of financial planning, which will comprise 5 episodes and have been scheduled for every Thursday of January 2026. The very first episode was held on January 1st and was taken by Mr. Biharilal Deora from Abacus and also a member of the Association of Registered Investment Advisors, wherein he focused on the foundations of personal finance and he covered various topics such as goal based financial planning, insurance, retirement, and investment planning. Today, we bring to you the second episode, which is titled Understanding Risks and Returns by Mr. Harsh Roongta. Harsh, sir, we welcome you to the Investor Education webinar. And to briefly introduce Mr. Harsh Roongta, he's a chartered accountant with extensive experience in financial services and entrepreneurship. He played a key role in setting up ICICI's retail lending business and later founded apnaloan.com and apnapesa.com, exiting successfully in 2014. He currently leads Fee Only Investment Advisors LLP, which is a SEBI registered advisory firm, and actively contributes to investor protection and policy through leadership roles at ARIA, which is Association of Registered Investment Advisors, Sehmati, and SEBI's APAC. A respected personal finance expert, he writes the column Truth Be Told for Business Standard, and is the author of the complete home loan guide. Mr. Harsh Roongta is a director and was also the past chairperson of Association of Registered Investment Advisor. Now I hand it over to Harsh sir so that he can take forward the rest of the session. Welcome, sir.
Thank you. Thanks, Rasmeet, and Happy New Year to everyone. And it is such a pleasure to see so many people log into this. So let me begin right away. You can see my screen, right?
Yes, sir.
Okay. So as Rasmeet mentioned, this is the second part of the five-part series on the foundations of financial planning. Uh, Today, what we are going to look at is understanding risk and returns. And, uh, people all the time, if you ask anybody, what do you want from your investments? Okay. Most people will say, oh, we want the highest possible return. I think what we plan to do today is explain what that entails. Wanting the highest possible return, what that means is something that we will cover in today's webinar. So let me ask a question, okay? And I will shortly ask Sahil to launch this poll. Let's say a very well-known personality has a entity. I won't say a company, but an entity, and they give a proposition to you that give them 20 lakhs, and in a year's time they will give back 30 lakhs. That means that's a return of 50% per annum. How many of you will lend this money to this entity? Very well known personality. Sahil, can we launch the first poll?
Yes, sir.
So as I mentioned, the polls will come up on your screen. Okay, this is an entity of a very famous personality which is offering to give you 30 lakhs at the end of the year for 20 lakhs that you lend to them. The return, as I mentioned, is 50% therefore. Okay, so are you willing to lend this money or no? You're not willing to lend this money. Your time has already started. We'll give you about 20 seconds to make up your mind. I don't think this should take a too much of time. There are three polls. I want you to answer what comes top of your mind. Recall. Can I see people uh, making their choices? Uh, okay. So we're going to stop the poll in about 10 seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Can we see the results, Sahil? So, okay, 36% of you said that you will lend the money. One third said they will lend. Two-thirds said that they will not lend. And I think the majority is clearly very wise not to lend that money because anything that gives 50% return is bound to be very high risk. Anything that appears too good to be true is likely to be too good to be true. Nobody can give you 50% return. As I tell people when I do these webinars that I, for one, would not even give 50% money at 50% even to God Almighty Himself. What to speak of a famous personality. So I think the first principle and I know two-thirds of you chose not to get enticed by the 50% return. And in real world, it does not come. I made it 50% to make it absolutely clear. In real world, it doesn't come at 50%. In real world, the offer comes at 18%, 20%. Now that still sounds plausible, but you must recognize that high returns, any return higher than the safest return entails risk. And risk means risk that you will lose your principal amount. That is what the way that we have defined risk. And very clearly, anything that promises super high returns, there is super high risk. Okay, even though that sounds so simplistic, very many people forget it, especially when the return is just a little higher than norm. If it was 20%, I'm sure a lot of you would have said, much more of you would have said yes than have said no in this particular poll. So, I mean, we just said two-thirds of you will not give money to a high risk product. Okay. So, can you tell me what is a good low risk product? And when we ask this question, the most obvious answer that we get is a bank fixed deposit. And, I've got the bluest of blue blood banks here. State Bank of India fixed deposit. Now, State Bank of India में अगर आपने fixed deposit दिया है, तो वो पैसा आपका कहीं नहीं जाएगा. ओके, मतलब स्टेट बैंक में रिस्क बहुत ही मिनिमल रिस्क है कि आपका पैसा डूब सकता है. आपने जो प्रिंसिपल लगाया है उसमें रिस्क, मतलब जीरो रिस्क कभी नहीं बोलना चाहिए, सेबी हमें अलाउ नहीं करता ये बोलना, बट इट इज द लोएस्ट ऑफ लो रिस्क इज ऑल दैट वी कैन से. बट लो रिस्क पे रिटर्न कितना होता है? प्रिंसिपल लूज करने का कोई रिस्क नहीं है, बट रिटर्न क्या होगा? लेट्स से 6%. Okay, so that brings us to the second principle. We saw that high returns always entails very high risk to the principal. But if I want very low risk to the principal, it will always mean low returns. You cannot get low risk to principal coupled with high returns. ऐसा प्रोडक्ट दुनिया में कहीं एग्जिस्ट नहीं करता. इंश्योरेंस एजेंट आपको चाहे कुछ भी बोले, ओके, लेकिन अ प्रोडक्ट जिसमें आपका कैपिटल रिस्क लो है और रिटर्न्स हाई है, ऐसा प्रोडक्ट एग्जिस्ट नहीं करता. बट ये एक बार इस पे लो रिस्क पे ही रहते हैं कि आर फिक्स्ड डिपॉजिट्स, आर दे रियली लो रिस्क? ओके, and I wish we had time for a little more interaction, but since we don't, okay, what could possibly be the risk इन आई जस्ट मेंशन कि आपने प्रिंसिपल अगर स्टेट बैंक ऑफ इंडिया में डाला है तो आपको अपना प्रिंसिपल वापस मिलना ही है. ओके, मतलब अगर स्टेट बैंक में प्रॉब्लम हो जाएगी तो हमारे को हिंदुस्तान में प्रॉब्लम हो जाएगी. ओके, सो वेरी क्लियरली प्रिंसिपल को कोई रिस्क नहीं है. तो अगर प्रिंसिपल को रिस्क नहीं है, व्हाट इज द रिस्क वी कैरी व्हेन वी पुट मनी इन अ एसबीआई बैंक डिपॉजिट? And this example will show you that risk. अब हमने देखा कि उस पे 6% का ब्याज मिलता है. ओके, इफ यू टेक टैक्स रेट एट 30%, net return becomes 4.2%. Let's say on the other side, you're going to use this money to say buy a dosa. If you had 100 rupees, you have two options. You can use that 100 rupees to buy a dosa, or that 100 rupees, if you deposit it in State Bank of India, they give you 6% minus 30% tax that you have to pay. So net return you get is 4.2. दूसरी तरफ समझ लीजिए डोसे का कॉस्ट 10% से बढ़ रहा है. ओके, तो शुरू के दिन आपके पास 100 रुपए थे जिससे आप एक डोसा खरीद सकते थे. ओके, लेकिन आपने उसको बैंक के फिक्स डिपॉजिट में डाल दिया. ओके, अगले साल आपके फिक्स डिपॉजिट की वैल्यू 104 रुपया 20 पैसे हो गई. 6 रुपए का ब्याज मिला, उस पे 1 रुपया 80 पैसा टैक्स लग गया, 4 रुपया 20 पैसा का इजाफा हो गया. इट इंक्रीज्ड बाय 204.20. The dosa meanwhile is now started costing 110 rupees, which means even though in the beginning you had money to buy a complete dosa, at the end of year one, because of inflation in food prices and the low return, low risk, low return, okay, you are now able to buy only 95% of the dosa. डोसे की साइज आपकी shrink हो गई. You keep going. I mean, second year में your fixed deposit goes to 108.58. Your dosa value grows to 121. Third year, it becomes 85%. Fourth year, it becomes 81%. Okay. Fifth year, 76. Sixth year, 72, 68, 65, 61. And if you take a 10-year horizon, at the end of 10 years, your value has grown from 100 rupees to 150.89. But what started off, you had 100 rupees that could buy you one dosa, but by that time the value of dosa has climbed to 259 rupees, which means with the same amount of money, even though it has grown, this you are now able to buy only 58% of the dosa. This really is the key risk that you carry. I'm saying risk that you carry in a supposedly low risk investment. A low risk investment we had seen will always have low return, and that low return, which becomes even lower because of tax, it cannot give you it cannot protect the purchasing power of your money. Therefore, it is effectively a low risk investment for the long term. In fact, is guaranteed high risk simply because there is no way it can protect the purchasing power of your money. So the key decision that you need to take, that an investor needs to take, is what is more important for them? Is it more important for them to grow from 100 rupees to 150.89 rupees or 151 rupees, or to still be able to buy one dosa at the end of 10 years? Alternative also will carry risks. Okay, but as we have seen, there is risk either way. When you do a supposedly low risk, the risk that gets attached is the inflation risk. It cannot keep pace with inflation. And any other investment that you do that supposedly keeps pace with inflation, gives you return above inflation, carries the risk of principal being lost. Before we look at that, let us also understand a third parameter that is very important when we are analyzing any investments, and that is liquidity. So let me just use this example. Let's say SBI offers two 5-year fixed deposit schemes. Scheme A, where you can withdraw within 5 years, you have to pay a penalty. Your interest reduces, but you can withdraw. You are allowed to withdraw. Scheme B, which does not allow you to withdraw. What would you think? Would SBI offer the same interest rate on scheme A as they offer on scheme B? The answer to that is very obvious. If the interest rate is the same on scheme A and scheme B, who in their right mind would go for scheme B? क्यों करेगा वो? Why would they voluntarily accept a restraint on their ability to withdraw that money unless they are compensated? रिस्क इसमें सेम है, दोनों ही केसेस में स्टेट बैंक है, तो रिस्क सेम है. लेकिन अगर आप वॉलंटरीली रिस्ट्रेंट ले रहे हो आपकी लिक्विडिटी को उसको विड्रॉ करने के लिए, ऑब्वियसली यू विल एक्सपेक्ट सम एडिशनल रिटर्न फॉर दैट मे बी 0.25%. It could be anything, but you will definitely expect some additional return from that. So that, I think, explains the role of liquidity. If you are willing to take, if any investor is willing to take a liquidity constraint कि मैं नहीं withdraw करूंगा, okay, या तो very clearly they will expect a slightly higher rate. Even the most complex investment instrument on earth, okay, you can pick out, Wall Street, go anywhere, pick out any investment instrument. It can be broken down into these three basic parameters: risk, return, and liquidity. And as I mentioned, all these three parameters are completely interconnected. So risk and return are connected. Risk and return and liquidity is connected. Liquidity and risk is connected. So everything is interconnected. One doesn't go without the other. So we are going to have some time for questions later on. But please do keep the questions there, and maybe if we are running on time, I may pause in between to take some questions, or we will take them at the end. So, we spoke about the fact that, low risk investments where there is very little risk to your nominal capital. Purchasing power नहीं protect कर सकता है, but nominal capital जो दिखता है उसको protect कर सकता है वो. ओके, तो परचेजिंग पावर को प्रोटेक्ट करने वाला इन्वेस्टमेंट क्या है? ओके, एंड दैट invariably 10 out of 10 people, if you ask, कि what is the investment product that over long term protects your purchasing power of your wealth, invariably they will say, oh, investments in the stock market will protect the purchasing power. Let us see how true that statement is. So let me now launch the second poll, which basically asks, does stock market, and stock market here is represented by Nifty 50. Okay, Nifty 50, presumably everybody knows, is a combination of the 50 largest stocks in India. Does it always, over 10 years, beat the fixed returns from the fixed deposit? So you have three choices. Okay, yes, stock market returns over 10 years always beat fixed deposit returns. B, which is a wishy-washy answer, no, stock market returns. Okay, so it says stock market returns over 10 years beats fixed deposit returns most of the time, but not always. And C is no, stock market returns over 10 years never beats fixed deposit returns. So this is a question I would like you to answer. I'm sure it is, you can see it on your screen. Please answer. We'll give you another 10 seconds. Don't overthink this, please. Just answer what comes in your head. I will give you 10 seconds to answer. 10, 9. Can we see the answer, Sahil? Okay, so the majority, in KVC, they call this the public poll, right? The public says that 60% or 59% of the participants feel that the stock market returns over 10 years always beats fixed deposit returns. Okay, so here is a time when, if this was a question in Kaun Banega Karodpati, and if the participant had followed public opinion, poor chap, he would have been out of the race. Okay, let me just show you how, and I'm going to show you with data. Okay, so let us take this specific instance, this specific 10-year period, 23rd March 2010, and fixed deposit here is represented by a liquid fund. So I'm just treating fixed deposit and liquid fund as the same. I mean, we can quibble about whether they are the same or not. For this purpose, I've used liquid fund data. Okay. So if you had invested in a fixed deposit slash liquid fund on 23rd of March 2010, okay, and got out of it on 23rd March 2020, your 1 lakh would have grown to 2 lakh 15,439. That's a return of almost 8%. So what do you think? Did the stock market returns will be higher for the same period? I think the answer should be obvious. I had already let the cat out of the bag. Absolutely not. Okay. During the same period, if this investor had invested in the Nifty 50, okay, his 1 lakh would have grown to only 1 lakh 64,979. Okay, and this is data, please. Okay, which means the return was only 5.13%, whereas the return on the fixed deposit slash liquid fund was 7.98%. So forget about, stock market beating liquid fixed deposit. Fixed deposit beat the stock market. It not only it beat it black and blue. मतलब 60% एक्स्ट्रा रिटर्न है, 5% के सामने 8% रिटर्न है. तो मतलब ऐसा नहीं है कि उसको हराया, उसको जम के हराया. इनिंग्स डिफीट, इट्स ऑलमोस्ट एन इनिंग्स डिफीट. ओके, नाउ व्हाट इज रॉन्ग with this way of deciding. So if you just look at this example, for an investor who had 2 lakhs and he invested 1 lakh in liquid fund on 23rd March 2010 and 1 lakh he invested in stock market, got out of it on both of them on 23rd March 2020, he would conclude, okay, कि भाई फिक्स डिपॉजिट और लिक्विड फंड बेस्ट है, ये देख लो, मेरा एक्सपीरियंस है, डेटा है, देखो. ओके, what is the problem with that conclusion? It is true. The return from stock market is 60% lower, okay, than a return from the fixed deposit. The issue is this is what is called a starting point and an ending point bias, or an unlucky start date or an unlucky end date. यहाँ पे अनलकी एंड डेट कौन सा है, किसी को ध्यान आ ही रहा होगा. 23rd March 2020 was the day on which Nifty dropped to 7,530 or something. It is currently at 26,000. Okay, in a space of what, 5.5 years or maybe 5 years and 9 months. Okay, it has sort of 3.5 times the Nifty itself has grown. So very clearly, this was a very unlucky end date. The start date was also mildly unlucky because it was after the recovery from global financial crisis. It was one of the days on which the market was on an all-time high at that time. Okay, so mildly unlucky start date, but massively unlucky end date. Okay, और उसको देखेंगे तो you come to a conclusion which is flying completely contrary to public opinion. Public opinion हमने देखा 60% लोगों ने कहा कि स्टॉक मार्केट बीट करेगा. ओके, और वो गलत नहीं है. गलत क्यों नहीं है मैं अभी बताता हूं. The problem is that we took one 10-year period out of context. उसको एक को उठा लिया हमने जिसका अनलकी एंड डेट था. ओके, उसको देख के अगर हम कंक्लूजन करेंगे तो वो सही नहीं होगा. तो क्या करें? अगर एक पीरियड को नहीं पिकअप करना चाहिए तो क्या करना चाहिए? सारे पीरियड को देखते हैं, सारे 10-year पीरियड देखते हैं ना. एक ही 10-year पीरियड क्यों पिक किया? Okay, let's look at all 10-year periods. And this is very important. This is the crux of today's presentation. Okay, what we have done is we looked at the data from 13th August 2001, and there is an interesting story why we have chosen such an odd starting date as 13th August 2001, for which we don't have time unfortunately. डेटा वहां से अवेलेबल है सारे एसेट क्लासेस का, इंक्लूडिंग S&P 500, इसलिए 13 अगस्त 2001 से लिया हुआ है. तो हमने एक 10 ईयर का पीरियड लिया, 13 अगस्त 2001 से 13 अगस्त 2011. उसमें लिक्विड फंड स्लैश फिक्स डिपॉजिट में 1 लाख डाला, वो इतना होता है 6.39. स्टॉक मार्केट में डाला, वो होता है 5.5 लाख, 18.77. अब सेकेंड पीरियड ले लिया, एक दिन से शिफ्ट कर लिया, 13 तारीख को नहीं करके 14 को किया. 14 अगस्त 2001 से 14 अगस्त 2011, ये 1 लाख हुआ, 1,85,000, 747. You can see it's slightly different. You can see stock market comes down, 551, 955. Okay, it drops a little bit, even 1 day difference. थर्ड डे 15 अगस्त छुट्टी होती है मार्केट की, तो 16 अगस्त 2001, you can see this is hardly moving. I mean, 2 डेसिमल तक में मूव नहीं हो रहा है, although figures change. Okay, स्टॉक मार्केट इज गोइंग डाउन 551 से 546. एक दिन के भी से फर्क पड़ रहा है, लेकिन बहुत कम पड़ रहा है. इस तरीके से एक एक दिन शिफ्ट करते 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 we came to the 2146 observation, which is the one we had seen earlier, the one that we started 23 मार्च 2010 से 23 मार्च 2020. उसका हमने ऑलरेडी देखा कि फिक्स डिपॉजिट का 8% और स्टॉक मार्केट का 5%। फिर एक दिन देखा। ऐसे करते हुए लास्ट 3522वां ऑब्जर्वेशन था 30 सितंबर 2015 से 30 सितंबर 2025। इसमें भी आप देखेंगे फिक्स डिपॉजिट करीबन करीबन 6.32, स्टॉक मार्केट इज 13%। तो ये तो इसमें तो आपको स्क्रीन पे तो सिर्फ 5 ही ऑब्जर्वेशंस दिख रहे हैं, बट टोटल तो 3522 ऑब्जर्वेशंस हैं। उसमें अगर आप देखें फिक्स डिपॉजिट में लोवेस्ट इज 6.32, मैक्सिमम इज 8.02, एवरेज इज 7.28। स्टॉक मार्केट में वेरिएशन देखिए, मिनिमम 5.13, maximum 22.42, average 13.69. And the most interesting data is that this 2146th observation, ये एक्सेप्शन नहीं है। 137 टाइम 3522 में से 137 बार, that's a non-trivial number. It's not a high number, but it's a non-trivial number. Fully 4% of the time, fixed deposits beat the stock market. They may not beat it black and blue, as in the 2146th observation, but they beat it. Okay. So the point is, stock market, if you look at it reverse, and that is the reason for the public opinion, right? Stock market beats FD 96% of the time. It has beaten in the past. Sorry, I think that's a general disclaimer. All of this is based on past data, and we are very clear. We are again and again required to state that past performance is not necessarily indicative of future results. So we are looking at past performance only to see if there are lessons that we can learn from that. One applies that with whatever logic one has for themselves, very clearly being aware that past performance is not necessarily indicative of future results. So coming back, I think this is the reason for the overwhelming public opinion. 60% of you said that a stock market always beats fixed deposits, whereas only 38% chose the correct option, which was that most of the time it beats, not always. And the truth is that it does not beat it always. 4% of the time, even over 10 years. 10 years is a pretty long time. क्योंकि हम लोग लॉन्ग टर्म की बात करते हैं ना, कि इक्विटी में डालो, लॉन्ग टर्म रहो मार्केट में, टाइमिंग करो। ये तो भाई लॉन्ग टर्म थे ना, 10 साल थे। 10 साल में भी 4% of the time, okay, you will make less money than fixed deposits if you do it this way. And the reason this is very important is that how do we decide whether an investment is working? I'm sure there are investors in this presentation कि मुझे तो ना स्टॉक मार्केट से फिक्स डिपॉजिट्स इतना पैसा भी नहीं मिला। ओके, सो व्हाट आर दे बेसिंग? This can be said even by a 10 person who stayed for 10 years. 4% of the time in the past it could have been said. For a 5-year period, 50% of the time that could have been said. Okay, we have done a similar analysis. Shorter the period, 3 years time, 18% of the time it can be said. And for 1 year period, 31 third, 1 out of 3 times. If you're just looking at a 1 year horizon, okay, 1 out of 3 times it will have lower returns than fixed deposit. It could also have loss, but it will have lower returns. Okay, and if you go for 6 months, okay, that will probably be 40%. We have not done the numbers. Okay, but it's clearly an increasing trend. Shorter the period, the chances of a liquid fund or a fixed deposit beating Nifty more often, and therefore people coming to the wrong conclusion, increases dramatically. And this is the crux of the problem. लोग कैसे decide करते हैं? People do a performance analysis. अरे मेरे फंड ने ना इतना ही दिया, तो सबसे पहले बात तो निफ्टी के साथ भी नहीं कंपेयर करते. चलो निफ्टी के साथ भी कंपेयर कर लिया आपने अपने फंड का रिटर्न, लेकिन आपने 6 महीने देखेंगे, 1 साल देखेंगे, तो यू कैन सी दैट, you know, as you look at it, shorter and shorter periods, end of the date on which you are doing the performance analysis could be an unlucky end date, or you could have started investing at an unlucky start date, and the two put together might be giving you returns that is leading you to a wrong conclusion. I just wish we had time for this thing, but I think the key lesson from this to take is that stop looking at what we call point to point return. मैंने जब पैसा डाला और मैं आज जब देख रहा हूं, 3 महीने हो गए, 6 महीने हो गए, साल हो गया, 2 साल हो गया, 10 साल हो गया. Okay, I just proved this to you that if you're just going to pick one arbitrary starting point and one arbitrary ending point, you may come to a wrong conclusion. And over shorter periods, coming to a wrong conclusion is even more possible. And therefore, disregard how it has performed for you. Look at rolling returns. So I just showed you 10-year rolling returns. We have done this for 1 year, we have done this for 2 years, and it's the same concept, right? This is the 1 year rolling return. What did we do? You take the observation number 1 lakh invested on 13th August 2001, disinvested on 2002. It's come down to 93,616. That's a minus 6.38. You move it one day, you can see the difference. In just one day's difference, the return, the loss increases from 6% to 8%. Another day's difference, it comes somewhere in between, and so on till you reach 30th, 5,740th observation. Okay, which is again a loss. Okay, so this seems to show only losses, but actually, okay, the average return has been 19% in 1 year. Okay, the worst has been minus 55, the best has been plus 110.1%. On an average, the 5,740 observations, if you just put them together, okay, the average return has been 19%. Or you could put them in a bell curve like this. I mean, those of you who are statistically challenged can probably understand this, that on this was the worst 1 year performance of the Nifty. So you can recognize this date, right? 20th November 2008, the global financial crisis. So from 20th November 2007 to 20th November 2008, your 1 lakh became 45,000 rupees. The best return was 23rd April 2003 to 23rd April 2004. Your 1 lakh became 2.10 lakh rupees. On an average, your 1 lakh became 1.19 lakh rupees, or a return of about, average return of about 18.69%. We have done something similar for 2 years. Okay, I'm not going to take too much of your time on this. Okay, but you will see the bell curve of 2 years is narrower. The number of observations are less over the same period. Spike of negative observations are 10%. In 1 year, the number of negative observations or loss is about 17%, 1 in 5. Okay, when you move it to 2 years, and you will be getting a copy of the presentation so you can compare this at your leisure. Okay, and this is data. I'm not presenting opinion, this is data. 1 in 10, it goes down from, the number of negative observations goes down from 1 in 7 or 1 in 8 to 1 in 10, and so on. So we have done basically all 10 years, and let's see how they perform. You can see it's 2 years, 3, 4, 5, 6, and something magical happens in the sixth year, right? There is no 6-year period during which you would have in the past made a loss on the Nifty. The worst 6-year period was the one that started from 7th of January 2008 and ended on 7th of January 2014. And the 1 lakh would have become 1.05 lakh, or a return of less than 1%, but positive, positive. So there is no 6-year period during which an investment into Nifty in the end has resulted in a loss. Okay, and that I think is the importance of stopping here. Then let us go, and you can keep seeing that as the period goes up, as the holding period goes up, the bell curve becomes narrower and narrower. The difference between the minimum and the maximum reduces. The average return drops. Okay, this, and obviously after 6 years, there is no loss. Okay. Now, this is the backbone behind what they say, right? That it is not timing the market, it is time in the market. So, this very clearly shows that in the past, if you have stayed in the market for a long time, it has rewarded you. In some few cases, up to 4% of the time over 10 years, it gave you lower than fixed deposit returns. But still, it rewarded you. On an average, of course, it's 13.69%. That's almost more than double the 6% inflation rate. Okay. So the key question is how many people got that average? So you can see this visually here. You can see this 1 year, 2 years, you can see visually, right? As the holding period goes up, it becomes narrower and narrower. So investment in equity becomes closer and closer to an investment, less riskier investment. Problem with, again, there is an issue with this, okay? And this is an issue that most people grapple with. We just saw that a 10-year return, okay, is about 13, the average return is about 13 point something, 6% or something. And here is a certain particular 10-year observation which I picked for a reason, which is 9th September 2014 to 9th September 2024. That is basically given a return that is very close to the average. So just let us see. Okay, if you had invested 1 lakh in fixed deposit slash liquid fund, that would have turned into 1,87,716 at a 6.5% return. Let's just see what happened to the investment that ultimately gave 13 point something, but how did it perform over the period from the time it started? So it started on 9th September. If you just break it after 1.5 months, it was dropping. It had become negative. Okay. Again, it was negative 16th December 2014. Okay. So again, negative on 6th May 2015. That is 6 or 9 months into the investment. Okay. And you can see that 24th August, okay, which is almost a year later, it's still negative. 21st November 2016, it's still negative. And it's way below the fixed deposit line, okay, except for a brief period here, right? It has always been below the fixed deposit line, okay. Then you can see it briefly went above the fixed deposit line, briefly flirted back to the fixed deposit line. But look at what happened in COVID. COVID happened 5.5 years from 9th September 2014. Look at what happened. It's again turned negative. 5.5 years later, your 1 lakh investment is worth only 99,902. Okay. So forget fixed deposit returns. Now Moody भी safe नहीं था. Okay. But after that, of course, it just took off. And it in the end ended at 3,45,000, which is almost double. Okay. And the return rate was 13.18%. The point is, this journey requires patience. It's not a comfortable journey. It requires patience. Past history, past history. Just remember that this is past history. Indian equities have rewarded in the past. Over 10 years, it has rewarded maybe 2 times what you would get from a fixed deposit, right? But look at the journey. It's a tortuous journey. Okay. सो इजी इजी पैसा नहीं है. आपको पेशेंस चाहिए, आपको वो हिम्मत चाहिए to live through losses after 5.5 years. I think that is key to this. I think we are running out of time, completely out of time. Unfortunately, I don't think we'll be able to do much of this. So let me just outline this and then I'm going to show you something else. हाउ डू यू देयरफॉर व्हाट डू यू डू. हमने देखा पहले कि 4% ऑफ द टाइम आपको जितना रिटर्न फिक्स डिपॉजिट से मिलता है उतना भी नहीं मिलता. उसको कवर करने के लिए आप क्या कर सकते हैं? तो आप 2+6+2 स्ट्रैटेजी जो है वो फॉलो कर सकते हैं, विच इज नथिंग, इट इज सिस्टमैटिक इन्वेस्टमेंट. तो पहले 2 साल आपने लिक्विड फंड में डाला और पहले 2 साल धीरे धीरे करके 5-5 हजार करके उसको निफ्टी में डाला, ताकि 24 महीने के एंड में 0 हो गया. फिर उसको 6 साल रखा. वो अज्यूम किया है कि 1,20,000 का 2,40 हो गया. ओके. और फिर उसको 10-10 हजार से आपको 10-10 हजार करके उसको 24 महीने में आपने विड्रॉ कर लिया. ओके. इस तरीके से अगर आपने इन्वेस्ट किया है तो ये इसके रिटर्न्स का, इससे आपका मिनिमम रिटर्न जो है 8.93% हो जाता है. 8.93%. एंड बट ऑफ कोर्स मैक्सिमम रिटर्न गिर जाता है 20.70 कंपेयर टू 22.42. एवरेज रिटर्न देखिए बहुत कम हो जाता है 13.69 से 12.25. बट एक बहुत इंपॉर्टेंट चीज है, फिक्स डिपॉजिट का हाईएस्ट रिटर्न वाज 8.02%. इसका लोएस्ट रिटर्न इज 8.93%. तो इवन द लोएस्ट ऑफ द सिप प्लस होल्ड प्लस SWP strategy, even the lowest return is better than the fixed deposit return, but after the end of 10 years. Again, you can see that the journey is quite painful. I am going to rush through this a little bit. This is what it does to the minimum. This was the worst possible 10-year history, which was, of course, the one that ended on 23rd March 2020. इसी को इसी को अगर 2+6+2 से करेंगे तो ये आप देखिए जो डार्कर लाइन है, that ends up almost double, and that's because it didn't wait till the last minute. It started withdrawing and putting it back into a liquid fund over the last 2 years. Impact of that, ये हमको तो पहले से नहीं मालूम था कि this is going to end as the worst one. तो अगर हमने ये रूल फॉलो किया तो जो बेस्ट था, तो बेस्ट जो निफ्टी का परफॉर्मेंस है, that was 1 lakh to 7.56 lakhs, 22.41. उसमें अगर 2+6+2 स्ट्रेटेजी फॉलो करी है तो वो गिर के करीबन आधा हो जाएगा, 4.16 lakhs. So very clearly, whenever you try to reduce risk, okay, you will also reduce returns. आपका एवरेज रिटर्न भी करीबन 1.5% गिर रहा है. तो एक चीज क्लियर है, a systematic entry and a systematic exit in a planned way, it helps you lock in the good market returns and keeps the ups and downs rather limited. Okay, तो अगर इक्विटी का सिस्टमैटिक इन्वेस्टमेंट करने से ये अगर इतना अच्छा रिटर्न्स है, तो दूसरी चीजें में क्यों देखें, क्यों हम गोल्ड की तरफ देखें, क्यों हम यूएस स्टॉक मार्केट देखें, क्यों देखना चाहिए. ओके, तो उसके लिए भी थोड़ी सी डेटा देखते हैं. पहले ये एक हम पोल लेंगे कि गोल्ड का ये रेपुटेशन है, ओके, कि गोल्ड ना कभी नेगेटिव रिटर्न नहीं देता, हाई रिटर्न्स नहीं देता, इन्फ्लेशन हेज करता है, ओके, बट नेगेटिव रिटर्न नहीं देता है. So let's do a poll, quick poll. Sahil, the third poll, okay, has gold ever made a loss over a period of 6 years? 6 years. ऐसा कोई भी 6 साल का पीरियड है क्या जब सोने में नुकसान हुआ हो? So quickly we're running out of time. Okay, I don't know how we're going to do, so I'm going to skip over a lot. Okay. So please answer whatever comes to your mind. We're going to close this in 5 seconds. 5, 4, 3, 2, 1. Can we see the answer, Sahil? So, okay, only 1/3 of you felt that gold has not made a loss over 6 years. Okay, we will see that. Okay, I think again the general perception is clearly the day it flies in the face of data. Okay, so again I'm going to show you the we have done similarly rolling returns, and you can see that gold behaves almost suspiciously like equity, slightly lower returns, slightly lower this thing. But look at this. Okay, this is the 7th year data. So if you look at 6 years, there is the 6-year data. 26/11/2012 to 26/11/2018. Okay, the gold 1 lakh investment in gold went down to 95,000. Okay, it had a negative return, and that was not the only one. 2% of the time, so maybe 90 observations roughly out of the 4,504 observations, roughly 90 observations were negative. Okay, 98% were positive. So very clearly, public perception is not based on data. Public perception, of course, is based on overwhelming data, but not based on the complete data. Okay, and again, you can see that this is very, very similar to equity. And similarly, therefore, because it is as volatile as equity, you can see that when you follow a systematic entry, hold, and systematic withdrawal, it helps you in improving minimum returns. It brings down maximum returns. It also brings down average returns. Okay, I'm going to skip this. I mean, this shows you 6.5 years, 6 years and 7 months when gold was negative. If you had started 17th of September 2012 and you looked at it on 30th of May 2019, your 1 lakh would have been worth only 99,006. So the reason you may want to invest in gold, okay, is that in the long run, gold has given very high returns, almost equivalent to stock market. But there have been 6-year periods during which the gold has given negative returns. In short run, gold tends to behave opposite to the stock market. It has a negative correlation. and therefore it is a beautiful instrument to add to the mixture. Okay, US stock market is very similar to Indian stock market. I'm going to rush through this. I have no choice. Okay, and again, because it is so volatile. Okay, when you do a systematic entry, hold, and a systematic withdrawal, this sort of gives you the same logic of unlucky dates. So why do S&P 500? Again, the issue is that in the long run, 10-year rolling period averages of the US stock market being S&P 500 is slightly higher than the Indian stock market. It's 14 point something versus 13 point something for the Indian stock markets. But S&P 500 is more volatile than the Indian stock markets. Okay, the biggest thing that the market value of all listed companies in India, and if you look at the market value of all listed companies everywhere in the world, the value of all listed companies in India is roughly 4% of the world's total. S&P 500 makes up 50% the world's total. So, we have a very good basket, but it is a pretty small basket. And therefore, it makes sense to diversify. It makes even more sense because data shows that even over long periods, S&P 500 is inversely related to the Nifty 500, to the Nifty 50. And therefore, when one doesn't work, the other does. And therefore, it's a great hedging instrument.
Hello, sir.
Yeah,
Sorry
I
to
know
interrupt you.
we are out of time.
Yes, and I can see lots of question in the Q&A section, so
Okay,
it will
and
take time
what I
as
will
well.
do is I'm going to quickly run through this. Therefore, I'll take 5 more minutes. I'll run through this and then we'll answer the questions.
Okay,
A
sir.
combination works much better, and we have data on the combination as well. Okay, so combination is much better. There is no negative returns after 3 years. Okay, and obviously a combination with systematic entry and withdrawal works even better. The best thing is if you look at the minimum return of the combination, which was 55% Nifty 50, 20% S&P 500, 10% gold, whatever is the balance was liquid fund. That's 11%. That's a minimum, double digit. Okay. In the past, please always remember, in the past. Okay. And it's so tight. The average is 12%, max is 16%. So we have learned here before we take your questions. Okay. Is that all volatile assets ultimately have delivered double digit average returns, though minimum returns over 10 years can still be in low single digits. The other thing we learned right in the beginning that if you want to maximize returns, you also maximize risk. Systematic investment, systematic withdrawal locks in high average returns of the volatile assets, and a diversified portfolio makes the best possible sense. And if you do periodic rebalancing, this what I showed you was without rebalancing. If you do periodic rebalancing, the returns smoothen further. They don't go up, they smoothen down. And just this is the last slide, anyways, that investment cannot be, and life cannot be only about investment. Just like investment cannot be about returns, life itself cannot be only about investments. You know, a truly fulfilling life, as Dr. Peter Attia says in his book Outlive, if you have not read it, I advise all of you to read it. That a truly fulfilling life rests on four pillars: wealth, purpose, family, and social connections. And I think all four pillars need to be strong for you to be able to lead a fulfilling life. Okay, with that, I will stop and take some questions. I'm sorry, the format does not allow interaction in between. Let me look at the questions. The questions are in Q&A.
Yes, sir.
Okay. Anonymous attendee, Vint claims 8-9% interest on fixed deposit and it is advertised openly. Should we consider this safe? And if not, then how can SEBI allow such ads? I can't answer this question. Sir, can you please continue only in English as we don't understand Hindi? Okay, I'm sorry, I saw this only just now. Yes, we can beat inflation in FD. Okay, okay. Can you not to use Hindi? Okay. Investment in stock market also involves high risk. Yes. How long will the asset class last? Okay. It is getting over. Isn't the data skewed due to COVID? That's an interesting question. No, the data is not skewed due to COVID, sir. Okay. When you do rolling period, okay, it takes into account all kinds of things. Okay. It takes into account the global financial crisis. It takes into account COVID. It will take into account other crises as they occur. That is the beauty of a rolling period analysis. When you are not doing it on because of an unlucky start date and an unlucky end date. Sandeep Kandari says asset allocation is a must. Absolutely, completely agree. Kamini Shah says inflation needs to be considered. Absolutely. Because of COVID, the stock market got crashed. Audio missing throughout. Was that true? I hope people heard this. Some people like me, okay, I will remember to use less Hindi next time. I can't help but lapse into Hindi. I'm really sorry. How would be performance of an active fund for the given 10 years? That will depend on the fund. There are not too many funds with a history of 20 years. Is it net of tax return? No, it's not net of tax. Taxes have been ignored for this. To note that up to 2018, equity capital gain and dividend was a tax has not been considered. Please share PPT. PPT will be available. What about real estate? Data is not available on real estate, sir. Okay. PPT will be available. Liquid funds being for sure they are redeemed before. Which investment is considered safer with guaranteed returns? I mean, I thought we covered this. There is no such thing as, you know, so if you want safe, SBI fixed deposit is safe, except that it does not protect you against inflation risk. What will happen in the future? Some Kishore Karade asks me, Mr. Karade, I have absolutely no idea. Okay, I can speculate just as much as you can, but I don't think anybody has an idea what will happen in the future. And therefore, the importance from this is to maintain an asset allocation. What should be an ideal asset? So, great question by Mr. Sanjay Sindhi. What should be an ideal asset allocation for persons moving into 30s and 40s? Mr. Sindhi, there is no such thing as an ideal asset allocation. Please remember that. It is like asking what is the, ideal vehicle for somebody. All vehicles are good. It depends on what you want to use it for. What is your budget? How many people will be traveling? What is the terrain over which you will travel? How much importance do you give to safety? What kind of a driver you are? How much time do you have? So there is no such thing as an ideal asset allocation. It needs to be tailor made. I'm sorry if it sounds like a pitch for our services, but that is exactly what financial planners do. Please do not go. Rule of thumbs can be very, very dangerous. Why can't you answer the wind question? I think wind question I answered. Okay. SEBI I can't answer. Obviously, wind question I answered. Anything that gives returns over SBI fixed deposit has risks attached to it, no matter what is advertised. There is question here on ETF and index fund. I don't think that is the right place to answer this. Gold is already high. So again, this is a issue. When you follow an asset allocation approach and a systematic investment and a systematic withdrawal, you are freed from this hang up about something being high. You are investing at all points of time if you are in your investing cycle. You are holding it if you are in the holding cycle, or you are withdrawing if you are in the withdrawing cycle. You don't look at market rates because you're not looking to do timings. My view on multi asset funds, that's exactly what I said. The biggest view on multi-asset funds is a portfolio makes much bigger sense. Unfortunately, in India, today, because of RBI restrictions, we cannot have international funds as a part of multi-asset fund. Second issue that I see people facing is that people treat it as a tick item. कि मेरे पास मल्टी एसेट फंड है, अरे भाई कितना है, has it meaningfully diversified? So first do asset allocation, then choose funds. People choose funds first and then do asset allocation. I think that should answer your question, Mr. Dilip Mahapatra. Okay, I think that finishes most of the questions. At least the questions I could answer. If you have something that I have missed, Sahil, we probably have 2-3 more minutes during which we could do it.
I think so. You have answered most of the questions. I want to answer two or a few questions regarding to the certificates and the presentation, which were asked by many of the attendees. So, want to tell all the attendees that they will receive certificate at their email address within 3 to 4 working days, and they can watch this session recording on NISM YouTube channel, where they can be taking their own notes by viewing the recording. Yeah. So
So
that.
in that recording, will they be able to download the PPT also, Sahib?
No, sir, not
When they
PPT.
go to watch the recording, will they be allowed to download the PPT? Is that a
No, sir.
possibility?
They
No,
can able to download the recording, but not the presentation.
not the. Okay.
Yes. Okay.
So there
So,
you have it. And I have been roasted for using a lot of Hindi, unfortunately, and I apologize, but I normally, if it was a one-on-one session, I would judge the person's felicity with the language. But let me give you a little secret why I use Hindi so much.
yes.
You saw that this had a lot of figures. Now, people like us, professionals like us, tend to lapse into jargon. Okay. The advantage of using another language, okay, which is probably not your natural language, is that there is no jargon for investment stuff there. Okay. And therefore, you are forced to simplify it in your head. You are also forced to slow down. Okay, because you are translating it. You're thinking in English, translating it into Hindi. You're forced to slow down. So I think those two things happen because of that. One, I'm forced not to use jargon, and two, I'm forced to slow down. There, you
Yes.
have it. Why I use so much Hindi.
Yes.
Thank you very much, everybody, for so patiently listening in. Uh, Thank you.
Thank you.